I'm Mike, and I'm the Chief Investment Officer here at Lighthouse Financial. And I'm here with another edition of our market update. So let's jump right in. So market update for February 2024. Here are my talking points. As goes January, so goes the rest of the year. And I'll explain what I mean by that in a moment, but the stock market is stronger than it was even 4 or 5 months ago. It's got a lot more breadth, and there are some encouraging signs here early in 2024. Next, of course, we have to talk about inflation and interest rates, which, boy, it gets dreary after a while, but it is so important to understanding the investing landscape right now. Inflation does continue to slow, which is great to see. And investors do expect lower rates this year. That's a change. A year ago, we were talking about how high do interest rates have to go. But now the debate is when will the Fed begin to cut rates and by how much? Finally, we'll talk about this head fake economy. We're just seeing absolutely surprising, almost shocking strength, which is again confounding Wall Street. Despite the fact that certain parts of the economy aren't doing all that well, like manufacturing may finally be stabilizing, but it has been in its own little recession for over a year. And there's this issue of commercial real estate. We all know that office real estate is not being utilized like it was pre-COVID, and then you add in much higher borrowing rates. And we could see some high-profile defaults, problems in the credit market. So despite these, it just seems like the economy is powering through. Okay, back to the stock market. This is the new bull. Of course, you know that. I've been talking about that for about the last 6 months or so. But I wanted to show you all the way back to pre-COVID. This is the S&P 500. Look at this. Just in the last few years, we've suffered through 2 significant bear markets, a 34% bear market and a 27% bear market. And yet, the overall trend is still upward. And I think this is a great illustration for why it's important to invest for the long term. I mean, how difficult would it have been to guess the COVID bottom on March, I believe it was March 23rd, 2020, and participate fully in the subsequent massive rally, and then guess again where the top of that was going to be before the 2022 bear market. Market timing doesn't work. It cannot work consistently because you're essentially trying to be a fortune teller. Long-term investing is the way to go, and you can see that even though as an investor you've had to put up with a lot of volatility over the last several years, the upward trend is still there, and that is the lesson. If we look back more than 100 years in the U.S. stock market, that is the same lesson. There's a trend, a definite tendency to go higher, and the stock market does move higher about 70% of the time, but not in a straight line. Okay, so let's zoom in and talk about just January, the month of January. You can see on the left-hand side here, I've pulled some search results talking about this concept of a January effect. And that just refers to this notion that if January goes well for the US stock market, well, then probably the rest of the year will as well. And historically, there is a correlation, and it's fairly strong. It's not 100%, but it's fairly strong direct correlation. And you can see on the right-hand side this chart that shows both the S&P 500 and the Dow Jones Industrial Average just for the month of January. Here again, you're moving upward. The trend is upward, but it is not a straight line. So, the lesson is essentially the same. We need to avoid the urge to panic when the market starts to go down and simply look at the data, look at the fundamentals, and try to figure out what the predominant trend is going to be. This is a nice sign. It's probably the least important sign that 2024 will be decent in my book, but nonetheless, it looks positive. Now, why? Why again? I'm going to ask it again. Why is the stock market rallying? Why, does it keep going higher? And here's one big reason: inflation is broken. And this is a chart from Morningstar, and it shows the Federal Reserve's preferred measure of inflation, which is the personal consumption expenditures price index. And so this is year over year, and here's calendar years, and you can see pre-COVID, inflation was 1 to 2%. Then it spiked to unrealistically high levels, but the Fed, having raised interest rates so much, they're curtailing that inflation. It's coming back down, and you can see 2023 at 3.8%. The goal, the target for the Fed is 2%, and that is what Morningstar expects for 2024. Inflation continues to fall. Inflation expectations also continue to fall. So that's great news, because maybe it means that we don't have to deal with really high interest rates in the future. Maybe that's a thing of the past, and the Fed will cut interest rates. So speaking of the Fed cutting interest rates, the Fed has a policy interest rate called the Fed funds rate, and it's a short-term rate. This is how they manipulate the financial markets in the U.S. They can move it higher, they can move it lower. And the light green bars here indicate what the Fed has already done. They've already raised interest rates above 5%. And when they do that, they don't just impact short-term lending rates, they impact all lending rates across the economy, from autos, which are relatively short-term, to mortgages, which are pretty long-term, everything in between. So I want you to notice, though, with the dark green bars, that's kind of expected, what we expect in the future, beginning with this year. Multiple sources expect the Fed to cut interest rates. And the first source shown on this chart is Morningstar. They're saying their best guess is that rates start falling this year back toward 5, because they're above 5 now, back toward 5, and then back under 4% by 2024. Excuse me, 2025. So that's one source. The next source is trading activity within the bond market, and that's that purple line with the dots. And that line is basically right on top of Morningstar's expectations. What that's saying is that big money investors are placing bets right now that interest rates, short-term interest rates, will be significantly lower by 2025. We're talking like 3.5% for the Fed funds rate. And then finally, the last source is the Fed itself, and those are the stars that you see in this chart. That's the Fed, sort of economists anyway at the Fed, trying to project how low they will take this interest rate over the next couple of years. And so they're a little higher than the bond market would expect now, but still the trend is lower. And what did I say earlier in this presentation? We don't have to get every detail right. What we're trying to do when we take a look at the fundamentals and make an outlook for the future is figure out what the predominant trend is going to be. And it seems to me that the predominant trend is going to be for still higher stock prices and still lower interest rates. So that's fairly positive. I think we are past peak interest rates. And you can see here the bank rate, average 30-year mortgage rate, is off from, it was above 8, and now it's below 7%. So without the Fed actually lowering interest rates, the bond market's already picking up on this. They are already, and so are banks, everybody else, they are already lowering interest rates in expectation of what's going to happen this year. Now, have they lowered interest rates too much for the near term? Maybe. That's the whole bond and interest rate debate. How many cuts is the Fed going to give us this year? That's a huge debate. I mean, some investors believe that we're going to start seeing lower interest rates at the end of March, that the Fed will cut by 0.25%. And there will be, 4 or 5, maybe 6 different quarter-point interest rate cuts before the end of the year. I'm not sure that's correct, Certainly the Fed is leading us to believe they will not begin cutting rates in March. Okay, but what's the predominant trend? Is it going to happen? Yeah, the Fed has led us to believe that it will happen this year. They're just not saying, well, it's definitely going to be March or it's definitely going to be April that we start. So there will be a little give and take, especially in the bond market. The stock market's up this year, not so much the bond market, partially because I think it built in too many rate cut expectations, and now we're sort of having to walk that back a little bit. Okay, and this chart here is crucial. The Fed is going to cut interest rates this year because they can, not because they have to. And that's critical. Usually what happens in a business cycle is that the Fed says, oh, the growth is too high in the economy or inflation's too high. We have to step in and raise interest rates and kind of calm things down. Usually though, they go too far. They take rates up too high, they keep them there for too long, and they end up breaking the economy. And they end up having to lower then rates after that because they have to, because the economy is diving. And they have to provide some relief. In this instance, just like sort of back in 1994, I think they can cut rates because they can, not because they have to. The can part is true because inflation's falling, and that's really what their main issue was with their rate hike cycle. They had to get down inflation. So here we are. This is part of the can as well. They can lower rates even though the economy is not tanking. So this is what's called real GDP growth, or growth in the US economy after you take away inflation, after you adjust for inflation. And you can see that last year's growth was 2.5%. That is higher than the Fed says is typical or normal. The Fed is targeting like a 2% growth long run for the economy. So it's 2.5. Remember, a year ago, investors generally were saying, we're going to have a recession, which means negative, right? That 2023 will probably, growth will be flat or it'll be negative. That didn't work out. It's been very resilient. And I want you to look at the forecasts here. And this happens to come from Morningstar, but I mean, just about every Wall Street firm now is on board with this kind of scenario. Nothing's negative. You look at 24, 25, 26, these are positive years. Maybe not as strong as we had this year. We should maybe see some slowing this year, but I mean, this is what I mean by head fake. We've been seeing recession around the corner for so long, or a slowdown around the corner for so long, and it's just not happening. So we got to put an asterisk behind that to slow down talk. One of the reasons the Fed can lower interest rates but doesn't have to is since they started raising interest rates back in March of 2022, the unemployment rate has not really spiked like they thought it would. In fact, a year ago they thought, well, we're gonna have the U3 or unemployment rate up to maybe 4.4, 4.5%. Just didn't happen. So you can see that line is completely flat. Very strong job market. Yeah, there are a few cracks that we see in it. It's not 100% the strongest we've ever seen, but my goodness, with unemployment at 3.7%, pretty much if you want a job, there is one. And then the blue line is consumer spending adjusted for inflation. That is, what is the growth rate of consumer spending after you back out inflation? And the answer is it's positive. Yeah, there's a slowdown you see in the left-hand part of this chart coming out of 2021 when we were all spending a lot of money post-COVID, and that rate came down. But I got to say, like where it is now, 3.2% growth, that's very healthy. So the consumer remains resilient, and it's really hard to contest that. I will say, though, again, there are some cracks in the foundation, some risks out there that we're watching. And here's one. This is from the Conference Board research organization using Bureau of Economic Analysis data. Personal interest payments as a as a percent of disposable income. So they just measure, do their best to measure American households, how they're doing, how much they have to pay in interest payments, interest on credit cards, interest on mortgages and interest on auto loan. And so you can see this chart spike up at the end. And yeah, it doesn't seem like a huge percentage, 2.8% of disposable personal income is interest payments, but that is higher than it's been since 2007. And we know that about that time is when the housing crash kicked in. So it's one of those things that makes you a little bit vulnerable if there is some shock to the economy. So we're definitely we're watching that. But overall, I gotta pull this quote from Jerome Powell in his speech this week. He's the chairman of the board of Federal Reserve System. He said almost sheepishly, let's be honest here. I mean, this is a good economy. And I wanted to bring that up because over the last 12 months, the predominant narrative in the stock and bond markets has been pretty negative. For most of the last 12 months, the bears were really on top. And I just want to recap in my own words, that narrative and how it shifted over the last 12 months. It started with recession is a virtual certainty here, and inflation's not coming down fast enough. The Fed is going to have to keep interest rates super high for a long period of time. They're definitely going to break the economy. And so we went on a few months into 2023, and yeah, we had that mini banking crisis, which was as close as a real shock as we've come. But then the market sort of shrugged that off, and the narrative had to change because the data didn't get any worse either. And so there was a subtle shift toward, yeah, the economy's been surprisingly resilient, but that only makes things worse because inflation's not going to budge. And the U.S. consumer, by the way, is in worsening financial shape. People have spent through all of that stimulus that they got during COVID, and so probably going to have a recession. Move on a few more months, and the economic data still didn't deteriorate much, and the narrative shifted again to, okay, well, recession might take another 6 months or so, but it's coming. So start crying now. The U.S. consumer's in really bad shape. Okay, let's move forward a few more months. And inflation starts to fall. And then the argument was, well, maybe goods inflation is falling, right? So tangible goods that people buy, but services inflation is not falling, like, auto repair or childcare. And what about this plight of the consumer? And by the way, where is that recession anyway? It's got to be around the corner, right? And I think moving into October, Halloween area, where things really started to turn in the market, and it became clearer that the economy was okay and inflation was falling. There were fewer bears, but they were still hanging on, and the recession changed to sort of, all right, maybe recession isn't going to happen in the near term, but stocks and bonds can't rally because economic growth is slowing, and interest rates are still too high for comfort. The Fed will not pivot. Well, then the Fed did pivot in December, admitting that inflation was coming down and that they thought they could begin cutting interest rates in 2024. So fewer and fewer bears are out there, but the ones that are out there are saying, well, the Fed can't possibly lower interest rates because the economy's too strong. Higher rates are going to keep stocks and bonds from rallying. And I want you to notice that subtle shift. It went from recessions around the corner, probably around the corner, it's got to be here somewhere, to where is it, to, oh, that's it. The economy's too strong and that's bad news. I just think that's wrong-headed. And I'll just go back to this quote, from Jerome Powell. Let's be honest, the economy is pretty good. So that's where we stand here at Lighthouse, and I'll let you see the disclosures, but I'm fairly positive on the year so far, and we'll have some volatility. We still have issues, as I said, with manufacturing and with with the possibility of trouble in the credit markets vis-a-vis this commercial real estate. But right now, I think the predominant direction is probably upward. Thank you very much for your time, and we'll see you in about a month.